The rules for sales returns and allowances has changed in the last probably 5 years. FASB is the Financial Accounting Standards Board. They're the ones who govern accounting rules. Rule 606. So you just might hear the word 606 because it's a relatively new revenue recognition rule. If you recall, we said you're supposed to recognize revenue when the earnings process is virtually complete. We said that basically is when the goods or services are delivered, is the general rule. But virtually complete really means when you're virtually assured that you're going to get the cash, at least eventually. So what companies were doing was interpreting this rule just a little too broadly. What FASB saw people were doing was something called channel stuffing. Another thing they were doing is setting up little side deals with people. For example, what channel stuffing is delivering, since that was the key point, delivering as much stuff this year as the retailers or the distributors would be willing to take. So you would just ship as much as you can. So for example, Sunbeam did this with barbecues. At the end of December, they shipped a year's worth of barbecue pits to the distributor, and so they could get as much revenue this period as they could possibly get. And there was this side agreement that the distributors and the stores could return them anytime for a full refund. They knew that when the newer models came out, a lot of those were going to come back, but they were delivered, so they met the rule of revenue recognition. Drug companies did the same thing, and there it was, they would ship again in December a whole bunch of product that expired in January or February, because a lot of those expensive drugs expire pretty quickly. For a local company, Monsanto did this with Roundup. The patent on Roundup was going to expire the next year. They knew the price of Roundup would have to go down because now a generic was going to be available. And they called all their distributors and all the stores and said, we're going to ship you a whole bunch. We don't know how much the price is going to go down when things settle down, but next year we'll credit your account or give you cash back for the amount of the price decrease. And so they recognized a lot of revenue in 1 year with the agreement that they really weren't going to collect all that. So those are just some of the examples. The problem with all of this is it really is a short-term solution to a long-term problem. Because if I shift all my revenue from next year to this year, I'm in the hole when I start next year. In Sunbeam, it made sense, though, because they were trying to sell the company. We didn't know about it at the time, but it might have made a little sense in Monsanto since they subsequently got sold to Bayer. So maybe that is what they were doing. For the drug companies, managers just kind of think, well, this is just a problem this quarter or this year, and next year is going to be better. Often this happens kind of at the local level, and this is why this is important to all of you, because you'll be managers of your store or your division. Let's give you a local example. When the SIUE was setting up their computer labs, they ordered a whole bunch of Zenith computers. And Zenith, the local distributor, called and said, we don't have enough of the right model, so we're going to ship you the wrong model. In January, we'll come pick them up and exchange the new ones. Well, clearly what was happening is the local manager needed those sales in this particular period. They could do that just by delivering the goods. If you tried to do that now, it would not show up as revenue, and we'll show you the journal entries below. I spent a lot of time on this because This is really the important thing. As a manager, while we said delivery was the key point, you can't deliver things where you don't think this earnings process is virtually complete and have it increase revenue and show up on your bonus. So we're going to use an example with lawnmowers. Toro actually did this many years ago. In November, Toro sells $2 million worth of lawnmowers to Lowe's with a related cost of goods sold, and they stipulated that the lawnmowers could be returned for a refund or exchange. And the new models come out in late winter, so let's say they come out in around February. Toro anticipates 40% of these particular mowers will be returned. And just to add a little incentive, the division manager gets a 1% bonus of gross profit. So that might be one reason they want to move revenues into this period. They make the sale, they would have credited revenues for the $2 million. Cost of goods sold, they would have debited for $900, with accounts receivable and inventory kind of being the other half of those two. We have an adjusting journal entry, and this is something the auditors will do when they come in. They'll look at your sales and see, is there anything that really is in the wrong year? The adjusting journal entry would be to get rid of that sales revenue, and you can call it revenue or sales, I don't care. That will go away for how much? We sell $2 million. We think 40% is going to be returned. 4 times 2 is 8. So $800,000 is what we think should not go in there. And the other half is refunds payable. Anything with the name payable is a liability. And that's for $800,000. So in essence, we're saying of this 200, 800 is not revenue this period, and we're going to owe those people a refund or an exchange. Since we're allowing an exchange, we're going to create an account called, spell it right, estimated returns inventory. That's an inventory account, so I'm going to put in here that's an asset, just so you know. That's going to be a percentage of this 900. 40% of the 900 is 360, I think. That's got to be a correction to the cost of goods sold, because remember, so that would be for the 360. And the reason you do that is if I look at the income statement, before the adjusting journal entry, I had sales revenue of $2 million on this particular sale. I then had $900,000 as my cost of goods sold. So that gives me $1.1 million as a gross profit. After I reverse out my 800, that gives me $1.2 million for my revenue. I had 900. I take out 360, 540. So now that's going to show as 660 as my gross profit. So clearly my bonus has gone down quite a bit, but that will then show really what I expect to collect, what really my sales revenue should be. So let's see what happens when somebody actually does return some of those mowers. February 2022, we'll just say the Texas region. I picked that because I figured their lawn mowing season would start earlier than ours. They return $200,000 worth of the mowers that Lowe's sent. Here I'm going to put on account. Read carefully. Some of them will say you returned it for cash. When I return it, I'm going to have to reduce this liability here because I don't owe them anymore. So I'm going to do the refunds liability, and to reduce a liability, you debit for the amount that I'm going to give them credit for. And by saying on account means I'm just going to reduce their accounts receivable for the 200. So that takes care of that liability. So of that 800, I've refunded 200, and there's still a whole bunch of lawnmowers out there that may come back later. Then I have to look at this inventory because now I've got some lawnmowers that have been returned to me. So I can still sell them. This estimated returns inventory goes down, reduce an asset. I'm going to credit it for the amount of the cost. Never ever do the sales price when you're messing with your inventory. 200 is 10% of that, so that would mean it's 90,000 is the amount that goes as my cost. You could come up with a cost per dollar. You could come up with a percentage that they returned. But I'm just doing the 10% of 90,000.
I reckon you know this, but the original cost of goods sold was $900,000, so 10% of 900,000 is 90,000. This gal can't talk and type at the same time.
And I'll just put up here, notice this is 10% of the total sale. And problems will work differently. Some of them will give you the amount, some of them won't. And so now I've got that in inventory for my 90,000. So now my refunds payable is reduced to the amount that I owe them. So 800 minus the 2, there's another 600,000 that I think might get returned. Same thing here on my estimated inventory. That was at 360, 90,000 have been returned. There's potentially another 270 that might come in. But most importantly, when I get the return, how does that affect that 2022 income statement? Is that an income statement account? Is that an income statement account? Income statement? Income statement? No, all these are on the balance sheet. So there's no impact on the 2022 income statement. And that's the whole point. The 2021 income statement is reduced for these non-sales, things we delivered but we don't expect to collect. But when the return happens, there's no income statement impact. So it shows what really happened in the year. Now if Lowe's would then turn around and buy some new lawnmowers, then I would have a sale here, but in 2022. But the fact that they're returning some stuff that you knew weren't going to be sold is the whole point. Finally, what if instead they ask for a price reduction and then they'll just mark down those older models rather than shipping them back to Toro? Lowe's just wants a credit, and then it's for $75,000, and they'll negotiate a price. If that's the case, you're going to reduce that refunds payable, which is again a liability, for the $75,000. This time it's going to go to accounts receivables for the $75,000. But there's no change to the estimated inventory returns because they're not sending you back that inventory. What that means is when the auditors estimate this returns, part of the deal is you estimate what's going to be returned and what isn't. In conclusion, as a manager, don't try to play games with the accounting. Normally it will catch up with you, and even if it looks good for this year, you're going to have problems next year.